Okay, so good morning to the lecture today. Yes, today we also, as you know, have the midterm exam in the evening. So I guess you all are aware of that. Probably that's also, yeah. There is nothing I have to add, obviously. I mean, you know what to expect. So just for clarity, are there any questions that are still unclear about midterm? So I just want to clarify one thing because I received some emails about that. The formula sheet does not necessarily cover everything that we ever did. So the formula sheet does not define what is relevant and what is not relevant. Relevant is everything, Unit 1, Unit 2, Unit 3, plus the relevant, the corresponding tutorials, okay? So the formula sheet contains formulas that you will not need. It contains basically the major basic formulas that you would also find in a math formula sheet, something like that, okay? So that's why we uploaded it. So if a formula cannot be found in the formula sheet, it doesn't mean that this topic will not be relevant, okay? So just for full transparency to avoid any confusion, okay? Good. Yeah, other than that, I mean, I've talked about it, Unit 1 to Unit 3 plus the tutorials. The midterm will have 60 points, 60 points. 60 minutes, so 1 point, roughly 1 minute. So this is for your personal orientation. If you feel that you cannot solve a 2-point question in like 3 or 4 minutes, probably move on to the next one. Okay? So it's your own guideline. Your own orientation on how long you should approximately need for a specific question. I mean, as I always say that, I mean, you don't need 60 points to get full scores, right? I mean, so even if you skip 1 or 2 MC questions, it's probably better than wasting 20 minutes on two small and multiple choice questions. Okay? Good. So, no questions? No, I will not reveal that. So the multiple choice and open questions both will have a very significant part in the exam. But I will not tell you exactly how much is this and how much is this. But very roughly, half-half. Okay? Any other questions? Good. Then we can start with the topic for today. So obviously the topic for today, Unit 4, this will not be relevant for the midterm anymore. Yeah. Unit 4 is called Applications, and the first chapter in Unit 4 is Equity Valuation. And I have to explain a bit why we talk about equity valuation now. Logically, in terms of the internal consistency of the topics, it would be more accurate, honestly, to talk about capital market equilibrium now. Meaning, after talking about portfolio theory, now we should continue talking about capital asset pricing model, arbitrage pricing theory, things like that. Okay? I'm not doing that. I'm talking about applications in equity valuation now, mostly because this is something that is likely relevant for your term project. So I want to talk about it a little bit earlier and not at the very end of the semester. So for couple topics, couple slides, I will actually have to refer to the capital asset pricing model, which we have not yet discussed in detail. And you will then hopefully understand better what I mean once we talked about the capital asset pricing model. Okay, so just for your clarity, this is a little bit of a mix-up of the optimal flow, and the reason is that this topic is likely relevant for your term project, which you should not start only at the end of the semester. Good. So equity valuation. The basic idea behind equity valuation, or why people do equity valuation, is that they want to earn money. Right? I mean, they want to earn money, and what I mean by that is that they want to earn excess returns. So what you try to do with equity valuation, you try to find the true underlying, or we also call this the fundamental or intrinsic value of a stock. And then when you have that, what you can actually do is you can compare this true underlying fundamental value of the stock with the current market price of the stock. And if the true underlying value is above the market price, I mean, obviously you are buying the stock. If it's below the market value, it's also good for you because you can short the stock. Okay? I mean, there is one assumption behind that strategy that is sometimes not clearly stated, but obviously if you do that, let's say you do equity valuation for HSBC stock and you find the value of the stock is 100, but you realize the market price is only 70, so you would obviously buy, right? What you are implicitly assuming is that over time the market price will approach their true value, right? Because only then you can make a profit. If the market price would stay below the true value in the long run, I mean, this would not be a profitable trading strategy. So the purpose of fundamental analysis is to find mispriced stocks. And if you can do that, you can make a profit in the sense of alpha. So you could generate alpha, meaning that you could earn returns that are higher than the returns justified by taking systematic risk. Remember, we talked about that already. Typically, investors, if they invest in a stock, they only get expected return. So the expected return is a function of the stock's risk. If you buy a riskier stock, you can expect more expected return. But, and this is what we talked about already, but we will see that more clearly and formally in the capital asset pricing model, the only type of risk for which you get reward is systematic risk. Firm-specific risk, unsystematic risk, will not be rewarded in terms of higher expected returns because it can easily be diversified away. So if we find alpha positive or negative alpha stocks, we can generate returns, or we can form portfolios that have expected returns that are higher than what would be justified by the portfolios or by the stocks level of systematic risk. Okay? So this is why we want to do equity valuation. So this is why people are interested in analyst reports. This is why a whole industry exists that focuses on valuing firms and writing analyst reports and providing guidance for investors. So this is why we want to do it. So how can we do it? Well, conceptually, I mean, it's relatively simple. So how much are you willing to pay for a stock? Well, you are willing to pay pretty much the present value of the expected future cash flows. Like this is like Finance 101, right? If you have a stream of cash flows in the future, I mean, what is the value today? Well, you just discount the future cash flows to today's value. using the risk-appropriate or risk-adjusted discount rate. And this is what you would be willing to pay for that today. So in a one way of looking at equity valuation is really that you simply determine cash flows and discount them to present values. Okay? Of course, in practice, that is not very simple, and there is a lot of complexity in that, but we will see when we talk about different models that the basic idea behind these models is relatively simple. Okay? The problem is more the practical application. So we will see that this is rather difficult often. So we will actually talk about 3 models today. We will talk about dividend discount model. We will talk about free cash flow valuation or dividend discounted cash flow valuation. And we will talk about multiples valuation. So dividend discount and free cash flow, they will be very close to what you see here, determining cash flows, discounting them. Multiples valuation will be very different. Multiples valuation uses a completely different approach. Basically, the idea behind multiples valuation is that similar assets should trade for similar prices. So if you want to value a firm and you don't know its value, but you know there is another firm which is exactly identical in the ideal scenario, then you would assume that the value of your firm equals the value of this identical firm. Of course, things are a bit more complex than this, but this is the basic idea. Comparable assets trade at comparable prices. Yeah, present value, I think that is all pretty clear. I mean, I'm not really going through present value, you all know that. So the basic idea behind present value concept, or behind the idea of discounting, is that, I mean, if I give you $100 today, $100 in 5 years, the value of $100 today is higher or lower than value of $100 in 5 years? Obviously higher, right? Why? Well, because you can take your $100 and you can bring them to your savings account, you can earn interest on that. The idea is, so the idea of present value, very simple. Actually, once we understand the idea of discounting a present value, it's very, very straightforward to do bond pricing. Bond pricing is actually very simple because bond pricing is nothing else than discounting. So if you want to value a bond or find the price of a bond, what you do is you're simply discounting the future cash flows of the bond, and this gives you the price of the bond. So let's look at an example. If you have a bond, and this is a coupon bond, 10% coupon bond, $1,000 face value. So this is written in the bond contract. How much are you willing to pay for that bond? Well, basically the present value of the future cash flows. So you write down the cash flows. You get 100 in 1 year, you get 100 in 2 years, 100 in 3 years, and you get the face value, the 1,000 in 10 years, plus the last coupon payment. So this is the cash flows. So you need to discount the cash flows to today's value. So you need to find the right discount rate. We can call it I. And I, as we all know, should reflect the riskiness of the bond. That's the risk-appropriate or risk-adjusted discount rate. So for simplicity, we can think about the riskiness of a bond as its default risk. Of course, there are other risk factors, liquidity risk, inflation risk, some others. But the most relevant, the most important one in the context of bonds is obviously default risk. So now if you have the bond contract, the very nice thing is that in the bond contract it's clearly written what cash flows, which cash flows you get in the future. The bond contract tells you you get 100, 100, 100, and so on and so forth. So then the investors can think about what they believe the default risk is. They adjust their discount rate and they end up with the price. So that's how bonds are priced, very simple. So the discount rate is actually determined by the market. So the market participants, when they think about which price they are willing to pay for a specific bond, what they are implicitly at least doing is they are discounting the future cash flows with the risk-appropriate discount rate. Okay? So, which is also the reason, I mean, what happens if the default risk of a bond goes up? And let's say suddenly you realize that, I don't know, the banking sector is more risky than you thought 2 weeks ago, so you increase your estimate of the default risk for HSBC Bank. So what happens is that I goes up, the discount rate goes up, and the price goes down. So if a firm becomes more risky, the price of its bonds decreases. Which makes perfect sense, right? Because if I offer you two investment alternatives, both have the same cash flows, both are bonds. One is very risky and one is not so risky. I mean, obviously you are willing to pay me a higher price for the less risky bond. That's more valuable to you. The formal explanation is really that your discounting for the more and the less risky bond would be different. More risky bond, higher discounting, lower price. Another thing that is worth mentioning here about this, bond pricing is really that if you remember, I showed you in one of the first lectures, I showed you the interest rates or the yield to maturities for specific bonds. Like we said, like US 10-year government bonds have an interest rate of 2.5%, something like that. Right? Where is this number coming from? Actually, this number is coming from such equations. There is no place in the financial market where people directly say, oh, the interest rate is 2.5% or the interest rate is 5% or whatever. What people do is they trade bonds, right? They trade bonds and then the bond prices change. And because we know the future cash flows of the bond, we can calculate I. So if you observe the market price for this bond is 900, you can solve for I and you can calculate which discount rate the market participants used to end up at the price of whatever 900 or so. So if I tell you the price, the interest rate on US government bonds 10 years is 2.5%, I mean, I haven't observed that directly. I basically solved this equation for I. I mean, I haven't done it. We don't have to do it by ourselves. This is what Bloomberg and Reuters and Google Finance and Yahoo Finance and a lot of financial data providers do for us. But how they end up with this is really like solving this equation for I. Okay, so bond trading leads to changes or leads to bond prices, and then we can use these prices to back out the discount rate, and this is then the interest rate on a specific bond. Okay? Good, so this is bond pricing or bond valuation. We are not primarily interested in that. We are more interested in equity valuation, but it is still helpful, right? Because if you would, for example, observe that there is a specific bond and the bond is traded for 950, but you disagree with the market's expectation, that you disagree with the discount rate that the market uses. You could, for example, think the bond is less risky. You could do your own discounting and you end up with a different price. And then you could decide that this bond is over or undervalued. So the same thing we try to do with equities, we can also do with bonds. We can come up with our own valuation of the bond. This process is relatively easy because the only thing we have to do is we have to be clear about what we think the right discount rate for the bond is. Okay, so of course, finding the right discount rate is extremely difficult, but technically, this is very simple. It's just discounting. So, equity valuation. Equity valuation is in its core, not really different from bond valuation. It's also about determining future cash flows, discounting them to present values. There is, however, one big difference to bond valuation. There is one reason why equity valuation is many times more complex than bond valuation. And the reason is that for equity valuation, obviously, if I go back one slide, we don't know the future cash flows and we don't know the discount rate. So basically in this equation, we know nothing, right? I mean, we know the future cash flows of a bond because they are written in the bond contract. And as long as the firm does not default, this is exactly what we get. But we have no idea about the future cash flows of a firm, of an equity, right? Because, I mean, probably the firm pays a dividend, probably not. Probably the firm is very successful, probably not. So there is a lot of uncertainty. We don't know the future cash flows, and we don't know the correct discount rate. So that's the double problem of equity valuation. We will look at three models, as I said before, that try to provide some guidelines or some, I probably wouldn't like to say solutions, but tries that provide us approaches how we can tackle these problems and how we can still do equity valuation. We will talk about dividend discount, free cash flow. Both are very classical models in the sense that first we predict something, we predict dividends, we predict cash flows, and then we discount them. Very traditional classical models, very much in the spirit of bond valuation. The third model we are talking about is called the multiples valuation approach, which is different. And as I said before, the idea here is that similar assets or comparable assets should trade for comparable prices. And then we will start from this idea and develop methods how we can also make different assets more comparable, actually. There are two remarks that are quite important to keep in mind when we talk about equity valuation. First, the book value of equity is not the value of equity. Okay, the book value of equity is an accounting figure based on historical cost, based on accounting rules, based on many different things, but it does not actually at all or mostly reflect the value of the stock. Okay, so this is a relatively old screenshot of Facebook, but it doesn't matter because this thing hasn't changed. This is the price of Facebook, $109. This is the book value per share, $15. Okay, so the book value per share has, for many firms, many times smaller than the market value. Okay, the book value per share, the book value of equity, if you think about it, does not include a lot of the things that make that make a firm valuable, actually. Especially if you think about young firms. I mean, when Facebook went public or when Twitter went public, people actually were very unsure how these firms should ever make money. But they thought they have great growth potential. Something like growth potential is not included in this figure. Right? The book value of equity is just reflecting like the current state of your operations, kind of. It doesn't include things like growth potential. It doesn't include anything that is related to customers, to customer satisfaction. Yeah? So it misses out a lot of the things that actually make a company valuable. Okay? So keep in mind the book value of equity is really not something that we want to refer to or rely on when we do equity valuation. So that's my first remark. Book value of equity, not helpful. Okay? Second remark, no matter which model we use, Equity valuation is very, very imprecise. It's very fussy. It's not an exact science. And actually, this is something that I hope you can also learn from your term project, that all of these models rely heavily on the assumptions that you make. And if you change your assumption, actually the outcome will change fundamentally. So this is also one of the things I want to tell you in this lecture today. I mean, for your term project, if you do equity valuation, I know this will be wrong. There is no way you can get this right. And that's absolutely not the goal. You can have a perfect term project, although your price is way off. We don't know the true price, by the way. I also don't know the true price, so I couldn't even tell if it's right or wrong. But nobody expects you to get this right, in the sense that you have to come up with a price of your company of $99.78 US. It's really more about the way, and I want to see that you know how to apply these models, that you know what you're doing, that you know your companies, and that you also understand this uncertainty, and that you can deal with this uncertainty. So I want to show you something that shows how professionals, that shows that even professionals, they come up with valuations that are very uncertain. Very much not an exact science. So this is Morningstar, a professional company, and they kind of have analysts, and they analyze HSBC. Okay? So what they then come up with is, this is a bit, it's like 2015, but doesn't matter. I mean, the basic message is still the same. They come up with a price of $40. So they basically say sorry, no, this was wrong, forget this. The market price of HSBC at that point of time was $40.12. That's the stock price, okay? Their fair value estimate is $47. So basically they do what you do in your term project. They run models and they think about the firm very hard and they try to understand the firm, and then they think, well, the actual fair value, the intrinsic value, the fundamental value of this stock should be $47. Okay? So if you look at that, should this be a buy or sell recommendation? Obviously buy, right? Because the value is 47 and the price is 40, so you can buy for 40, but the value is 47, okay? But at the same time, and this is the point I want to make here, at the same time they say that the uncertainty about their estimate is high. And what this means is actually what you see in the next slide. They say you should consider to buy the stock if the price falls below $28. You should consider selling the stock if the price rises above $73. Okay? So basically what that means is between $28 and $72, which is a relatively large range. They don't know. Probably the fair value is $30, probably it's $50, it's $60, they don't know. Within that range they give you no recommendation. Only if the price is lower than this or higher than this, they say, oh, now it's really so high that you should sell, or it's really so low that you should buy. Okay? So even professionals cannot tell us a single price that is right. I mean, they probably can give us a range. And that is also for your term project something you might consider. Instead of saying the price, the fair value estimate is 47.98, you could give a range. That's perfectly fine. That's probably even better. You could say, look, the most likely value is 48, but it could be somewhere in the range, according to our models, from 30 to 60, something like that. Okay? So I just want to encourage you to be open about this uncertainty. That's actually good and not bad. Don't hide this uncertainty. So yeah, this is something we always have to keep in mind. Equity valuation is absolutely not an exact science. And this is the kind of cartoon way of telling it, which has a lot of truth in it. So this guy says 12 financial analysts came up with 12 different valuations for the same company. All they had in common was their fee. Which is what you often see. I mean, if you look at analyst reports from different analysts for the same firm, you often see very different valuations. Good. So having said that, let's talk about the models that we have. They're not perfect, but they can give us some guidance on how we can think about the problem and how we can tackle the problem. So the first model we talk about is the dividend discount model. So the basic idea behind the dividend discount model is very simple. It is that over an infinite time horizon, firms will pay out all their profits as dividends. So in order to determine the value of the firm, the only thing we have to do is we have to discount all the future dividends to today's value. I mean, theoretically, there is a lot of strength in that, because if a firm has, like, if you think about a firm over its whole life cycle, at some point, the firm will pay out the profits to its owners. So if we can determine these future payouts, these future dividends, and then we discount them to today's value, this should be the value of the stock, right? So, two problems, of course. I mean, how can we determine the dividends, and how can we determine the discount factor? Turns out the discount factor is kind of okay-ish. I mean, it's not super hard. At least we have some model guidance. So the discount factor should reflect the riskiness of these cash flows. So from an equity investor perspective, the riskiness of these cash flows should be the cost of equity. The cost of equity, and we will talk about that more when we talk about the capital asset pricing model, is the expected returns of that security. So if you're an investor, you have a specific expectation about the returns on a specific stock. So in other words, you are only willing to buy a specific stock if the expected returns are high enough. So if you have a stock and the expected returns are 2%, but you require 5%, otherwise you will not buy. I mean, you will not buy, right? So what determines how much return you expect from a stock? Well, obviously the risk of the stock, right? I mean, if I give you a very risky stock and a not so risky stock, and I tell you, look, both have an expected return of 7%, you will always take the less risky option. So I have to offer you a premium on the more risky stock, a premium in terms of higher expected returns, so that you consider the more risky stock. So I think that the idea that risk matters and that risk determines how much return you expect on a stock, this is pretty obvious. We don't need a model for that. Where we kind of need a model is the second step in our thought process, which is that not all risk matters. So the capital asset pricing model will actually tell us, and we talked about that already, that the only risk that matters is systematic risk. And the very simple intuition for that is that firm-specific risk shouldn't matter because you are not exposed to it as long as you hold diversified portfolios, right? I mean, if you buy the stock of HSBC, I mean, you don't care about the firm-specific risk because typically the stock of HSBC would be part of your larger equity portfolio, so all firm-specific risk would be diversified away. So the only thing you care is the systematic risk of HSBC. And this is here the first time where it's like, as I said at the beginning, the logical flow is not perfect. So actually it would be better to talk about this model, the dividend discount model, after we talked about the capital asset pricing model. But again, I'm still switching the order kind of because I want to talk about valuation earlier so that it can be more helpful for your term project. We will see that the capital asset pricing model puts this idea into a formula. And what the capital asset pricing model tells us is that the expected return on a stock is nothing else than the risk-free rate plus the market risk premium. The market risk premium is the expected return on the market minus the risk-free rate times beta. Okay? Beta we already know from the index model. So beta is basically a measure how much the stock kind of co-moves with the market. The market risk premium here we can calculate based on historical data, or we can use expert opinions. I mean, if you Google market risk premium, you find estimates on this term here. So different people, analysts, have thoughts or opinions about what the market risk premium should be. Yeah, risk-free rate, we can find that. I mean, that's probably something like the T-bill rate or money market fund rate. And then we can, not easily, but then we have a relatively straightforward way of calculating the discount rate, the cost of equity. Okay, so that's the discount rate in our dividend discount model. The hard part is actually forecasting the future dividends. Forecasting the future dividends is very tricky, very difficult, and I cannot give you a very clear guidance on how to do that because it's very much dependent on the firm. I will come back to that, but let me already say that now. Theoretically speaking, you can use the dividend discount model for all firms. You can also use it for firms that are not paying dividends. Okay? Theoretically speaking. In practical terms, it's often very difficult to apply the dividend discount model to firms that are not paying dividends, because how you typically estimate future dividends is that you look at the past dividends, you try to find some trends, and you try to build some forecasts based on past dividends. So a very common way of like predicting future dividends is that you look at the past dividend history, you kind of find some trends, growth factors, something like that, and then you adjust those trends according to your expert opinion on the firm. So like, for example, if you find that, I don't know, BMW had a dividend growth rate of 2% or 5% over the last 10 years. And then you think, well, but I think as an expert on BMW that the growth rate will go down because there will be more competition from electric car manufacturers, from Tesla, from Chinese companies. Then you could scale that down to probably 4%. So that's how people often do this dividend forecasts. Good. So let's look at the model a bit more formally, but it will be very simple. So in its most simple form, the dividend discount model is a one-period model. So the price of the stock today is the dividend you get in the next period, in the next year, plus the price at the end of the next year. Okay, both discounted gives you the price. So very simple. Let's say the dividend in the next year is 16 cents. The price at the end of the next year is $60. Discount rate 12%. So this would come from the capital asset pricing model. Gives you a price of $53. Okay. I mean, quite obviously, this one period model is not too helpful in practice. Right? Because it requires you to know the price of the stock after 1 year. So if you want to calculate the price of this or the value of the stock today, typically, I mean, you don't know the value of the stock in 1 year. If you would know the value of the stock in 1 year, I mean, why would you want to know the value of the stock today? So think about this as kind of the foundation of the model. It's not like yet the one that we typically apply or that people apply. Okay? So what is more applicable to practice is the so-called generalized model, where we extend this one period model to n periods, and basically in its most general form just say that the price of a stock is nothing else than the dividends in the future discounted and summed up. Okay? Very simple. So the problem here, of course, is that the sum goes from now until infinity, which is also a bit hard to handle because probably you don't want to forecast dividends until infinity. So one way to get around this problem is that you assume that the dividend is constant, right? If the dividend is constant, so the dividend is the same in every year and the discount rate is the same in every year, actually this sum converges. And it's very simple to handle. So, and this is not specific to this model, this is specific to discounting. Let's say you receive a cash flow of 100 forever, and the interest rate, the discount rate, everything in the universe is like 10%. What is the present value of this cash flow? You get 100 forever, every year I pay you 100, and the discount rate and interest rate and everything in the universe is discounted and interest rate is always 10%. What is the value of this cash flow? 1,000, right? Why? Well, the simple intuition is that if you get 100 forever, if I offer you this cash flow stream, there is a simple way for you to replicate this cash flow stream, or an alternative to get the same cash flow stream. You can put money on your savings account. So how much money do you have to put on your savings account to get 100 every year? Well, obviously 1,000 if the interest rate is 10%, right? So the present value of a cash flow stream that is received forever is simply the cash flow divided by the discount rate. So that is basic discount, okay? So if we assume that the dividend is constant, life's very easy now, then let's say the dividend is 100 and the discount rate, cost of equity is 10% and the price would be 1,000. Okay? Of course, I mean, a constant dividend is probably an assumption that people often don't want to make because we assume that firms grow and it's not like always constant. So people then extended this model to what is called the Gordon growth model. And the Gordon growth model allows for a growth in the dividend. Okay? So basically the idea of the model is that the dividend in year t plus 1 is the dividend in year t times 1 plus a growth factor g. So the dividend in every year grows by factor g. And then we can show, I mean, I'm not formally showing that, but it's relatively simple. I mean, the price is the sum of all these future dividends. I mean, that hasn't changed. But now we can get rid of the sum. And actually we can write it's the dividend in year 0 times 1 plus g divided by ke minus g. So ke is again the discount factor here, and g is the growth rate. So and this is then nothing else than the dividend in 1 year divided by ke minus g. So why divided by ke minus g? I mean, divided by ke, I think that is clear. I mean, that's just the convergence of the sum, the same thing we had when we do the constant dividend here. Right? Why do we have to subtract g here from ke? Well, the intuition is that if you think about the reason why the sum converges against a specific value, the reason is that the further you go in the future, the smaller the present value becomes, right? Because of the discounting. Like 1,000 years from now, no matter which dividend you get, it will not matter because the discounting makes the present value of this so small that it's actually irrelevant. So that's why the sum converges against a specific value. Okay? So ke, the discount rate, makes the sum converge against a specific value because the further we go in the future, the smaller the present value becomes. So now we have an opposing force. A force that works against that, and this is g. Because the further we go in the future, the more the dividend has grown, right? Because it grows at a rate g every year. So if you go 1,000 years into the future, the dividend will be much, much higher than today because it has grown by g 1,000 times. So that's the intuition why those two things work in opposite directions, right? ke, the discounting, makes the sum converge, but g works against this convergence by adding more and more, by making the dividend higher and higher every year. And now you can easily see what happens, if you think also about this intuition, what happens if the growth rate equals the discount rate. If the growth rate, G, equals the discount rate, KE, what happens is, of course, I mean, this is divided by 0, so it's not defined. But why is it not defined? Well, because there is no convergence, right? If KE equals G, the sum is just infinite. It's just not converging against a specific value. Because the further you go in the future, I mean, of course, the discounting becomes more severe, but the growth is exactly offsetting this discounting effect. So the present value of all future dividends will be the same. So you have a sum of whatever until infinity, so it's unlimited. It's infinite. And obviously, if KE, if G is higher than KE, it's also not converging. So that's the basic idea. So yeah, let's do the example. It's very quick. So, I mean, applying that is really very simple. Assume you have a firm that pays a dividend of $1 now. We expect a growth of 5%. Cost of equity is 10%. So what is the current equilibrium stock price? Well, yeah, we just set in the values to this formula. So the price is the dividend in 1 year. So it's 1 times the first growth rate, 1.05, divided by KE minus G, so we get $10.50. Oh, sorry, that was wrong. KE minus G is 0.10 minus 0.05, so we get $21. Okay? So now we can play around with that a bit, because of course, I mean, all these parameters here, they have to be estimated in practice if we do that. We have to estimate the cost of equity. We have to estimate the growth rate. That's all not given. And because it is not given, there is a lot of uncertainty about it. So what we can now do is we can see how the results change. We can analyze how the results change if we change assumptions. This is kind of a sensitivity analysis. How sensitive is the result to our assumptions? So for example, we could now assume that KE is 15% and not 10%. So we just set in the value, do the calculations again, and we find that the price is now $10. So you see, I mean, this is all very fragile in a sense. KE is estimated. We first need to estimate beta, then we need to estimate the market risk premium, we need to estimate the risk-free rate. There's a lot of uncertainty. And if we only increase the cost of equity by 5%, from 10 to 15%, actually the price of the stock halves, only half. Okay? And then we can, of course, play around more. We can change the growth rate, and we will find another price. But I think this is a nice way to think about dividend discount models. Also because of their simplicity, if you do them, if you apply them, it's very straightforward to come up with different valuations for different assumptions. So you can easily change your assumption about the growth rate. You can easily change the way you calculate the cost of equity. And then you can show different outcomes for different assumptions, so that then the readers of your reports get a better feeling on how uncertain this all is. And by doing this, you can come up with a range of prices. You can say, look, I tried 20 different assumptions. 15 are in the range of $15 to $25, and the other 5 are in the range of $10 to $30, something like that. How exactly you do that is completely up to you. But again, I want to encourage you to actively manage this uncertainty and show this uncertainty. And one way of doing that is to rerun the calculation with different assumptions and be very open about the outcome and how the outcome changes. Okay? Good. Let's have the first break now, 10 minutes. Okay, so let us continue. So we're just talking about the dividend discount model. This example, you see, if you change the numbers, if you change the assumptions, actually the results can be quite different. Okay, so something we should always keep in mind. Good. So this was the generalized model. Then there is a third kind of type of the dividend discount model, which is called the multi-stage growth model. Okay. The key idea behind the multi-stage growth model is that firms typically pass through life cycles or through phases. Okay. So in the early years, firms face a lot of investment opportunities. So they are young, probably they are in a new area, new technology. So whenever they make profits or whenever they raise money, it's quite natural for them to keep the money within the firm and invest it in new technologies, new facilities, new people. So payout ratios in the early phases of the life of firms are typically very low. So if firms are young, startups, but even after startup phase, if they went public, payout ratios tend to be quite low. Growth is rapid. In the late years, things change. So industries become more competitive. There are less attractive opportunities to reinvest profits, because there are more competitors having the same technology, having the same ideas, working in the same industry. So then firms can't lose opportunities to profitably reinvest their money. And what they often do at this point is then that they decide to pay out the money to the shareholders, which of course also means then that dividend growth slows down and kind of approaches a long-term constant growth rate. So again, the idea is beginning of the life, when firms kind of start paying dividends, like the growth rates of the dividends is very high because they go from 0 to a certain level of dividends. But then after some time, when the firm becomes more mature, the growth kind of stops and the growth becomes more moderate and flattens out at a certain level. And one way how we can incorporate these ideas into the dividend discount model is shown here. I mean, it's very simple. It's actually the same as we had before, but it's really just a minor tweak. The tweak here of the multi-stage growth model is to divide time into two periods: a detailed forecast period, or a first period, and a second period. Both periods can have different growth rates and different forecasts. In this example here, we have a firm that pays a dividend of $2 now, cost of equity of 13%. And we assume that in the first period, which is 3 years, the dividend growth is 30%. So assume this is a young firm. They just started paying dividends here, so they are growing rapidly and rapidly increasing their dividend. After 3 years, the growth becomes lower, and 6% is then the long run constant growth rate. Okay? So first 3 years, very high growth of dividends, 30%. after the first 3 years, the growth becomes 6%, long run average. So how can we now perform a dividend discount analysis? Well, relatively simply, we just kind of calculate the future dividends. So we started we know the growth rate is 30%. So in 1 year we have 2.6, 2 years 3.38, 4.3, and then the constant growth period starts. So here from 3 to 4, the growth rate is only 6%, so it grows from 4.3 to 4.6. Okay? Very simple. And then what we do is simply to discount all these cash flows to today's value. The discount rate is always KE equals 13%. So the 2.6, the 3.38, everything is discounted. And then we have to remember the multi-stage growth model. This one. Here, this formula. The price in the generalized model is the dividend in 1 year divided by KE minus G. And this is what we apply here now. So if we are in year 3, basically the constant growth period starts in the next year. So the price in year 3 is the dividend in the year plus 1. So in year 4, so 4.65 divided by KE minus G. So this gives us a 66 price in year 3. And obviously we also have to discount the $66 then to today's value of $46. So if we add up everything here, we have $54. So the price of the stock, according to this calculation, would be $54. So again, the idea of this multi-stage growth model is that we can have different phases of the firm. I mean, theoretically, you could extend it to 3, 4, 5 phases, whatever you want. So you have a detailed forecast period, like the first 3 years, and you can assume a high growth rate. Or you could also, in your project, you could forecast the dividends one by one in this detailed forecast period. And then after some time, let's say after 5 years or after 10 years, you could say, look, there is no way I can predict dividends for more than 10 years. So after 10 years, you assume that there is a long-run constant growth rate. So you split time into a detailed forecast period and a long-run constant growth period. And how you do that, I mean, exactly like this. You can easily extend that to more periods, to more, or to detailed forecasts instead of this growth rate here. Good. So just some observations from this calculation. Is the stock price based on short-term growth in this model? And kind of interestingly, if you look at that, the stock price is 54, yeah, and 46 of the 54 comes from the value that is generated after year 3. So actually a very high percentage of the value of the stock in this model comes from things that happen in year 4 and later. So it's actually 85%. So 85% of the stock price is related to long-term dividends, which means that small changes in growth expectations will have a huge impact on the price. Because if you change the growth assumption here, if you change it from 6 to 4%, actually this price here will change dramatically and the value will be very much impacted. Okay? A little bit more philosophically, I mean, you can ask now the question, if according to this model, the price is mostly coming from like long-term dividends or cash flows, why do managers in practice, and we know this quite a bit, focus so much on short-term earnings, right? And the reason is really, you can also see the reason in this picture. The problem is that people also in reality, practitioners often have some very simple models in mind, something like this, okay? So what happens now if you as a manager announce bad quarterly earnings, for example. I mean, if you do that, what happens is that people immediately adjust their opinions about your next dividend. Here, the growth rate probably goes down to 20%. And if the growth rate goes down to 20%, I mean, this has effect on all the future expectations, right? If we have 20% here, this becomes lower, this becomes lower, this becomes lower, the long run dividend becomes lower, and everything will lead to a much lower price. So, in some sense, the reason why managers focus on short-term earnings is because short-term earnings carry a lot of information for investors about long-run growth prospects. So in that sense, it's not so easy to distinguish long-run from short-run effects, because changes in short-run effects can carry information about changes in long-term prospects. Okay? So from that perspective, it makes sense to focus on short-term earnings, because if you fail to meet your earnings targets, investors may dramatically adjust their expectations about your future growth as well. Because, for example, they think that there is some fundamental structural problem in your firm, or that consumers do not like your products anymore. So then they adjust all their expectations and your stock price crashes. Okay? And there are other reasons, but it's not so important. I mean, more on a personal level, of course, managers have incentives to focus on quarterly earnings because their bonuses are often tied to quarterly earnings. Yeah. Good. So what do we think about the dividend discount model? I mean, it's definitely a useful model. It's theoretically a very nice model because it's so simple. I mean, you can really do that. I mean, doing dividend discounting, if you have all the data, takes you 2 minutes. Right? I mean, it's basically just setting in a couple numbers in a formula. It's very, very simple. So theoretically, that is nice. Of course, we need to have a few assumptions that are fulfilled so that the model becomes kind of usable. First, obviously, at some point, we will have to assume a constant dividend growth rate because we cannot predict dividends until infinity. So we need to assume that dividends start growing at a constant rate at some point of time, which is typically fine. The second thing we have to make sure is that the growth rate of dividends G is lower than KE, because otherwise things will not work out here. I mean, let me go back. Here you can see it. I mean, if G is higher than KE or if G equals KE, I mean, the model doesn't converge. This is typically also fine, especially if we split. If you have younger firms, it might be different. Younger firms might have growth rates that are above G, growth rates that are higher than the cost of equity. But you can easily get around that by using these different time periods. You can have the detailed forecast period when the firm is still young and has a very high growth rate. And after the firm becomes more mature, I mean, the growth rate naturally goes down and it should fall below KE. Then you can do the long-term constant growth model and you can use the formula again because there is a convergence. Okay? So this is also not something that typically hinders us from using the model. Of course, the challenge is the real challenge is coming from these two things that you have to calculate. First, we need to calculate KE, the cost of equity. Not super simple, but still also not super hard. I mean, we can use the capital asset pricing model, which tells us that KE equals the risk-free rate plus the market risk premium times beta. All three elements are relatively easy, probably not easy, but all three elements can be calculated without too much effort. Okay? So that's also not the most critical one. The most difficult one is determining the correct growth rates and the dividends themselves, of course. So this requires estimating the firm's growth rate over long time periods. And typically is not simple. As I said before, what people often do is they use past dividends, they kind of try to find trends in past dividends, back out growth rates, and then use their expertise about the firm to adjust these growth rates to their opinions about the firm. Okay? So one thing we should keep in mind here is that if firms do not pay dividends, this is relatively hard to do. Theoretically still possible, but practically speaking, it's a bit hard. Okay? So this picture actually shows some recent, no, not so recent, but some pretty fundamental change in payout patterns. So like in the 70s, 60s, 50s, also early 80s, basically all firms, at least on the New York Stock Exchange, paid dividends. So something like 90% of all firms. So the green line here is New York Stock Exchange firms, and this is the percent of firms that pay dividends. So it was very, very common for firms to pay dividends. But sometimes in the mid-1980s, late 1980s, this fraction of firms paying dividends started to drop. And now it's less than half, probably much less than half. So here, this stops in like around 2000. It was around half, but kind of the declining trend continued. Okay? So if you look at other exchanges, I mean, Amex are mostly smaller firms, but if you look at the tech firms at the NASDAQ, I mean, they always had much lower dividend payout ratios. So only like around 10%. So the message from this slide is really that nowadays, if you look at the US, we do have a lot of firms that are not paying dividends. Okay? For these firms, especially tech firms, it's typically hard to apply dividend discount models. Okay? So why are firms not paying dividends anymore? Or why did so many firms actually stop paying dividends? Any ideas?
Part of it the tax reasons, and they wanted to stop buybacks instead.
Yes, that's probably the most important reason that firms didn't stop paying out money, but they switched the way how they pay money to shareholders. So they switched from dividends to share buyback, share repurchase programs. Okay? The reason why they did that is probably, there are a couple of reasons, but you mentioned taxes, that's an important reason. So for some investors, it's actually more beneficial from a tax perspective to get money in the form of share buybacks compared to dividends. But also from the firm's perspective, share buybacks have a big advantage over dividends. In the sense that share buyback programs are less binding and less of a commitment than dividends. So one of the things that there are surveys when people ask the managers, why did you stop paying dividends? And one of the things that a lot of managers said is that actually they don't like dividends because they are such a strong commitment. And what they mean by that is that investors are very upset if you cut their dividend. If you start paying a dividend of, I don't know, $1 per share, basically you have to continue paying this dividend until infinity. If you cut the dividend, or if you omit the dividend and say, oh, this year was a bad year, you don't get a dividend, investors are super upset, and we typically observe a sharp decline in the share price. So investors kind of assume once you start paying a dividend, they will always pay a dividend, and they kind of demand that. Which of course is hard for firms because you have good years, you have bad years. So in good years, you probably want to pay out a lot, but in bad years, you don't. And dividends are very inflexible in that way. Buyback programs are much more flexible because investors know that buyback programs are kind of one-time events. And if you have a large buyback program today, it doesn't mean you will have one in the next year. right? So it's more flexible for firms. It's more like one-time events where they pay out a lot of money to shareholders, but they can more or less time that. So when they have a lot of excess cash and they don't know what to do, they do buyback programs, give the money to shareholders. If they have a lot of good investment opportunities, they keep the money within the firm and invest. So yeah, that's kind of a little bit off topic, but that's really why we see a lot of firms stopping to pay dividends in recent years. Which brings us back to our topic, also the reason why for many firms, dividend discount models are difficult to apply. Not impossible, but difficult. The good thing is, like outside the US, it's still kind of a bit different. I mean, outside the US, at least the larger firms are still very often paying dividends because share buyback programs are not yet so common. But the trend goes in the same direction. So even in Europe and in Asia, you see some decline in the payout, in the share of firms that use dividends. This brings us to the next model, the free cash flow valuation. So the basic idea of the free cash flow valuation is very similar to the basic idea of the dividend discount model. So we discount all future free cash flows instead of dividends to today's value. If we discount all the future free cash flows to today's value, what we get is the value of the firm. So which is a bit different from before. When we discount the future dividends, we get the value of the stock, the value of equity. When we discount the future free cash flows, we get the value of the firm. Which isn't a big deal, because if we have the value of the firm, we just have to subtract the value of debt, and then we have the value of equity. Okay? So basic idea, we have assets. Assets generate cash flows. So there is a cost for generating cash flows, and the cost is the cost of financing these assets. And how are these assets financed? Well, equity and debt. So basically, this is like how we do the discounting. We take the cash flows and discount them by the cost. So this will be the discounted cash flow model. So if firms are financed by debt and equity, we have to discount the future free cash flows by a combination of both, by a combination of the cost of equity and the cost of debt. And this is called the WACC, the weighted average cost of capital. So the weighted average cost of capital is nothing else. Let's start with the equity part. And the cost of equity times the relevance of equity for the firm. So the share of equity, the share that equity takes in the financing of the firm, which is the value of the equity scaled by the value of debt plus value of equity. Value equity scaled by value of debt plus value of equity times the cost of equity. So that's the equity part. So the debt part, if we ignore that here, is basically the same. So it's the cost of debt financing before taxes times the value of debt scaled by the value of debt plus the value of equity. So again, this is how relevant debt financing is for the firm. So obviously, if the firm is only equity financed, VD would be 0, and WACC would be RE, because this term here is 0 and this term here is 1. Okay? So the only thing that is a little bit out of the ordinary here probably is the 1 minus T term. I guess you've seen that before, but the WACC change with taxes. The reason is that debt financing has a tax benefit. Why? Because interest payments are tax deductible. That means if you are financed with debt, your taxes will go down because the interest payments reduce your profits and the basis on which your tax is calculated. So if you have two firms, exactly identical, but one is only equity financed and the other one is 50% equity, 50% debt financed, they have exactly the same cash flows, sales, cost, everything exactly the same. The one with debt and equity financing will have higher profits after taxes because they pay fewer taxes. Again, because interest payments reduce their profits so that the taxes actually go down, that the basis for their taxes goes down. Okay? Good. Yeah, so the cost of debt here reflects the riskiness of the debt, and the cost of equity obviously reflects the riskiness of the equity. So cost of equity, again, very simple. We can use the capital asset pricing model, so risk-free rate plus market risk premium times beta. So this here, how can we calculate the cost of debt? Well, the cost of debt, there are different ways to calculate that. If you wanna calculate the WACC for your project, the most straightforward way would be to check if your firm has bonds outstanding, publicly traded bonds, and then you look at the interest rate or the yield to maturity of these bonds. So basically what you do is you solve this present value equation that I showed you at the beginning for I. So normally you don't have to do that. If there is a bond, I mean, Bloomberg, Reuters, whoever, they will provide you with information on the interest rate. So if the firm has a bond outstanding, that's good news. You can relatively easily approximate the cost of debt. What do you do if the firm has no bond outstanding? The firm has no bond outstanding, it's a bit more tricky. If a firm, for example, is only financed via loans, bank loans, what is the difference between bank loans and bonds? Bank loans are not public, they are private. Right? I mean, this is a private contract between a bank and a firm, and we cannot find, also in Bloomberg or Reuters or Refinitiv or whoever, we can typically not find information on the interest rate that firms have to pay on their bank loans, because that's private. That's secret information between the bank and the firm. So if the firm has no bonds, what you can do is two things. I mean, first you can look at the firm's annual reports, 10K statements. Quite often, at least not too rarely, firms do actually mention the cost of debt that they have in their annual reports. So they say we are financed by private debt from bank loans. Our average cost of debt financing is, I don't know, 7%. So if the firm has no public bonds, you should check the annual reports, 10K statements, things like that, if there is some information on the cost of debt. If that's not the case, your last chance or last option is basically to estimate or to approximate the cost of debt. And one way of doing that would be you find a firm that is comparable to your firm. And by comparable, I mean it should be similar in the most relevant dimension for debt pricing, which is default risk. So you could find a firm that has the same rating. And then you look at the cost of debt of this other firm. So for example, if you know the rating of your firm would be, I don't know, BBB, then you can look at bonds of BBB rated firms or BBB rated bonds and their interest rates, and you can use that as kind of a proxy for the interest rate of your firm. Of course, this is not very precise, but yeah, it's kind of how equity valuation works. So again, if there are bonds, everything's relatively simple. You just use the interest rate from the bonds. If there are no bonds, you can check annual reports, or you find comparable firms with bonds, and then you calculate the interest rate from them. Good. Yeah, tax deductible, corporate taxes reduce the effective cost of debt. So this is why we have the 1 minus T here, because the effective cost of debt, kind of the after-tax cost of debt, are lower than the before tax cost of debt. So that's why we multiply by 1 minus t. And we will see in a second, I mean, that how that is also relevant for us. So then free cash flow valuation is actually relatively, again, straightforward. I mean, free cash flow is the amount of cash that is available from operations and can be distributed to all investors, so stakeholders and debt holders, after the necessary investments to support the operations are made. So we can use very simple discounting to obtain the firm value once we know the expected cash flows. So basically the firm value then is nothing else than the sum of these future cash flows discounted to today's value. And the discount factor is WACC, weighted average cost of capital, plus 1. Quite straightforward. So if we have the value of the firm, so that's the firm value, then we can calculate the value of the equity by subtracting the value of the debt. Firm value minus the value of the debt is actually the value of the equity. And then if you divide that by the number of shares, we get the value per share. Okay? So I will also come back to that in 5 minutes or so. But just to mention it already now, I mean, if you have the firm value and you want the equity value, again, you subtract the value of debt, theoretically. The problem is the value of debt is often hard to guess or hard to calculate because most of these debt contracts are private contracts, right? I mean, it's not public bonds. So a very common, typical shortcut is that you actually use the book value of debt as an approximation for the market value of debt. So what many people do is firm value minus book value of debt equals equity value. Good. Free cash flow. How can we calculate the free cash flow? Well, again, very simple. Just a few steps. So we start with sales. We subtract the cost, and we do subtract the depreciation. Why do we subtract depreciation? Well, what is depreciation again? Well, this is an accounting figure, right, that distributes the value loss of an asset over the economic life of the asset. So from an accounting perspective, if we buy a machine today, it's not like all the expenses are relevant today. The accounting people distribute the value loss of the machine over time. Right? From a cash perspective, and we are calculating a cash flow here, that's obviously different, right? If I buy the machine today, I have cash outflows today. I mean, I'm paying 1 million for the machine today, and I'm not paying anything tomorrow and the year after that. So from that perspective, we would not want to deduct depreciation here because it's a pure accounting figure. It's not cash relevant. We are still deducting depreciation here for the simple reason that the depreciation changes the tax basis. Okay? Sales minus cost minus depreciation are earnings before interest and taxes. And then taxes are calculated based on earnings before interest and taxes. So our taxes are earnings before interest and taxes times the tax rate. Okay? And this then gives us the net operating profit less adjusted taxes. If we would not have done that, if we wouldn't have subtracted the depreciation here, I mean, the earnings before interest and taxes would be too high, and our taxes would be too high. So we subtracted here and we added back here. Again, we subtracted here because it's necessary to calculate the correct taxes, but we don't want to subtract it because it's not a cash relevant position, so we add it back here. So that gives us then the net operating cash flow. From the net operating cash flow, we also subtract other things that are cash relevant, which is investments. So again, this would be the machine that I buy. I mean, if I buy the machine for 1 million, I mean, I have a cash outflow of 1 million. So net operating cash flow minus investments. plus minus the change of net operating working capital. So these are investments, for example, in inventories. So if I buy inventories, then I have a change of net operating working capital, a cash outflow, which is again obviously cash relevant. Okay. So this whole thing here then gives us the free cash flow in the entity approach. Free cash flow entity approach. There is a second approach, which is called the equity approach. So this is basically the cash flow here in the entity approach that is available to both the debt and the equity providers. Both debt and equity providers. The equity approach additionally subtracts a few things here like interest payments, debt repayments, and then the equity approach ends up with the free cash flow that is available to the equity providers. Important to remember is that if you use the entity approach, you end up with the firm value. If you use the equity approach, you end up with the equity value. Okay, so just don't mix those two things up. Equity approach, equity value, entity approach, firm value. Okay? So let's do a quick example on free cash flow valuation. It's a very simple example. I hope it makes things a bit clearer. So this is a project, or you can think about it as a firm. And we're making a lot of simplifying assumptions here. Like, for example, that this is only having an economic life of 4 years. We have certain costs for the assets, 200,000 plus shipping, plus installation. Depreciable cost is then 240,000. We have a specific depreciation scheme, which is the MACRS 3-year class, whatever. Doesn't really matter. You could use anything you want here. And then we assume that the firm stops all operations and sells all assets for their book value after year 4. So that means the salvage value, the value at the end of the year 4 will be 0. Okay? So what you can see from this example is that, or what you will see from this example is that, I mean, again, the methodology applying the free cash flow method is very simple. The tricky part is really the forecasting. The tricky part is to come up with good free cash flow forecasts. That is the core challenge of the free cash flow method. Like the core challenge of the dividend discount method is coming up with good dividend forecasts. The core challenge here is coming up with good cash flow forecasts. And what do I mean by cash flow forecasts? Well, you need something like this, right? You need to know the annual unit sales in the future. You need to know the sales prices in the future, the unit costs. You need to know the net operating working capital, things like that. Okay. So this is what we assume here. So unit sales 1,250, sales price 200, cost 100, net operating working capital is 12% of the next year's sales, 40% tax rate, 10% WACC, and inflation is expected to be 3%. And unit costs and prices go up with inflation. Okay, so that's the setup of this example. And if you think about your own valuation, I mean, this is, of course, what you would have to do for your firm. You would have to come up with these forecasts. Okay? So the depreciation is very simple. I mean, we have the 240K as the basis for the depreciation. And then this scheme has a specific percentage that you depreciate every year. So then you get the annual depreciations here as 80, 100, 8, 36, and 70. Okay? So what we then do is we take all this information and predict all the future free cash flows. And this is exactly what you would do in a free cash flow valuation, also for a firm. You try to come up with cash flow forecast for the next 5, 10 years. And typically, what people do is they do not predict the free cash flow as a whole, in general, in total. They predict the different components of the free cash flow. Sales, costs, taxes, things like that. because it's normally very hard for us to think about the whole overall concept of a free cash flow, right? It's easier if you are an expert on the firm to predict the firm's sales, cost development, tax development, things like that. So yeah, then this would look, I mean, this is highly simplified, but this would look something like this. You have unit sales, you have unit prices, you have sales, you have unit cost, and some multiplied by these units, you have the total cost. Sales minus cost minus the depreciation that we calculated gives us earnings before interest and taxes. 40% of that is our taxes. That gives us the net operating profit less adjusted taxes. We add back the depreciations again because that is not cash relevant. That gives us the net operating cash flow. Okay? Very straightforward. We just basically summarize what we already knew here. Yeah, what is the net operating working capital? We said it's always 12% of the next year's sales. So now we know the next year's sales. So we always use 12% of the next year's sales. So that's the net operating working capital, 12% of next year's sales. And the cash flow is the change in net operating working capital. Think about it as if you start your operations, you have to purchase all the inventories, all the raw materials, things like that. But then you only have to care about the change. You have to expand if you grow. But if you're not growing, you don't have to expand. Yeah? So then we have the last summary here. The free cash flow is then the investments that we have to make, purchase of the machinery, plus the net operating cash flow. This is what we calculated here, 2 slides before, plus the net operating working capital cash flow. This is what we calculated on the previous slide. So if we then sum up all of that for every year, we get the free cash flow for the next 4 years. So this is all really very simple. I mean, it's just like showing the general structure of everything. I mean, then I think the path is pretty clear. I mean, we do now have the free cash flow for the next, these 5 years. So what is then the entity value or the firm value? Well, just discount the future cash flows using the WACC, and you have it. The firm value is the sum of these cash flows here. So this is the free cash flows. We discount them to today's value using the WACC, which we said was 10%. So the entity value is then 78K. Okay? Assuming that the firm has no debt, assuming there are 1,000 shares, I mean, then the share price would be 77,784 divided by 1,000, so $77.7. Okay? Obviously, you can make this example more complex and complex to the level you like. I mean, you can make this incredibly complex, right? I mean, you can add 10, you can extend the 4 periods to 10 periods. You can make much more detailed forecasts. You can make forecasts for different business divisions of the firm. You can add debt financing here. You can add whatever you want. But I think the basic idea remains the same, right? I mean, you try to predict the components of the free cash flow. Then you calculate the free cash flow in the future periods. You discount to today's value using the WACC, and this is your entity value. So, having said this is all simple, when I started the example, I don't want to give you the impression that this is easy to do in reality. Of course, in practice, this is pretty hard, right? Because if you have your firm, I mean, predicting all these components is very difficult. What I mean by it's simple is that the methodology behind it is very simple. The hard part is really the prediction and coming up with good ideas of how to predict cash flows, sales, costs for your firm. And that is really what is your job, right? I mean, you have to know your firms and your industries so well that you can come up with reasonable predictions, which will, of course, be wrong. I mean, I'm not expecting you to get things right, but you should find ways how you can in a structured way, think about it. How you can explain to me and other people why you predict cash flows to increase by this or that. Okay? Good. So, this is how you can do it. Predict future cash flows, components of future cash flows, discount, entity value minus book value of debt typically gives you equity value divided by the number of shares gives you the share price. Okay? All right, let's have the second break now. 10 minutes break. Okay, let us continue with the last part for today. So, what are we doing? We are talking about free cash flow analysis, free cash flow valuation. We said we predict the future cash flows, discount to today's value, gives us entity value, subtract value of debt, book value mostly, gives us the equity value. Okay? So one thing I want to make clear here again is that typically it's a good idea not to come up with one valuation, but to do something that is called a sensitivity analysis. Okay? In a sensitivity analysis, we change some parameters and then recalculate the firm value. So if we use that for the free cash flow valuation, you would, for example, change the sales forecast or the cost forecast or the WACC forecast, any forecast that you make, and then you recalculate the firm value or the equity value and then check how sensitive the model output, the value, is to these input factors. Okay? So for example, you can do a calculation, you use the capital asset pricing model, and you've according to your calculation, the WACC is 10%, but you know that there is uncertainty about that. It could also be 11 or 9% or something like that. So then you recalculate the whole firm value using WACC values of 9 and 11 and look how this changes the outcome. And you can repeat this process for multiple other parameters where you change them a little bit and see how the value changes. So at the end, what you then got is models with many different parameter choices, and every model leads to a firm value. So at the end, you do not get one single firm value, but what you get is a distribution of firm values. Right? I mean, if you do 100 different parameter estimates, you get 100 different firm values. If you do 1,000,000 different, I mean, I'm not saying you should that, you would get 1,000,000 different parameter value estimates. So if you have a distribution of the firm value, that's probably much more reasonable than coming up with a single value, right? Because then you could say, look, I did my best effort and I estimated all these parameters, but I know that they might be wrong, so I checked how sensitive my results are, and my equity value is somewhere between $20 and $60. The most likely value is probably $40, so that's kind of the peak of your distribution, but it could also be 20 or 40. Something like that you could do. But you can be creative. So in any case, I want you to be reassured that I I'm not expecting you to get it right. I'm more expecting you to kind of deal with this uncertainty, for example, by explaining it well, by doing sensitivity analysis, by showing how sensitive and how fragile your outcome is to certain assumptions that you have to make. Okay? Good. So this brings us to the last model, which we are talking about, the so-called multiples valuation. The idea of the multiples valuation, as I said before, is really very simple. The idea is that similar assets should trade at similar prices. Okay, so if you have an asset, a firm that you want to evaluate, that you want to value, what you could do is you could find another firm that is very comparable to this firm. And then you could look at the value of this other firm and say, look, the other firm has a value of 1 million. My firm is very comparable, so it should also have a value of 1 million. Okay, so that's the basic idea. Of course, in practice, it's often hard to find a firm that is exactly comparable, exactly the same. So multiple approach takes this one step further and says, look, probably we cannot find a firm that is exactly comparable, but probably we can find a measure for value and a measure for performance, or measure for performance that basically explains this value. So the idea is then as follows. Let's say the firm you want to value is a social network. Okay, social network company. And your social network company has 20 million active users. Okay? Okay, you know there is another social value company, let's say Facebook. Facebook has 100 million active users. And you know Facebook has a value of 100 million because you can observe the market price. I mean, of course, I'm making up these numbers. Yeah? So then the multiple would be 1, right? The measure for value would be 100 million for Facebook. Performance measure would be the number of active users, 100 million, so the multiple would be 1. Every active user then translates into $1 of market value. So now if you know that your social network has 20 million active users, obviously the value, according to this approach, should be 20 million. Okay, so that's the idea of multiple valuation. There is really a zoo of different multiples, and the difference is which performance measure you use. Performance measure could be earnings, could be sales, could be whatever. But also things like customers, active users, things like that. So there's a huge heterogeneity in the performance measures that people use. But the idea is always the same. You try to understand how the performance measure relates to the value, and this is then your multiple. Okay? And then you have the company that you want to evaluate. So you take the performance measure of the company that you want to evaluate, number of active users, earnings before interest and taxes, sales, whatever, and multiply it by this multiple. Yeah? So my previous example of the social network was a little bit simplified because I said like the multiple of 1 was calculated only based on one firm, right? I said there is one firm, Facebook, 100 million users, 100 million market value, so the multiple is 1. In reality, you would calculate this multiple not only based on one firm, but based on probably 5 or 10 firms. Okay? So you would use Facebook, you would probably use Twitter, you would probably use Instagram or whatever, and calculate their multiple. And their multiple would always be the relation between the number of active users and their value. Okay? And what will be also very important here, it's kind of really the key to multiples valuation, is that you should calculate this average multiple based on comparable firms. Firms that are comparable to the firm that you want to value. So if you want to value a social network, you shouldn't use the multiple of an electricity company. You should use the multiple of other social networks. If you want to value a AI firm, you should use the multiple of other AI firms. If you want to value a car manufacturer, you should use the multiple of other car manufacturers. It should always be comparable firms, and I will show you in a few slides why this is so important. Multiples tend to be very different across industries and across firms that are not comparable. Okay? So, but again, that's the basic idea. We calculate a multiple, which is the measure for value scaled by a measure for performance. So that's typically equity value or firm value, and the performance measure could be anything, basically. And then the corporate value of the firm that we want to evaluate is this average multiple of comparable firms times the performance measure. 20 million active users in my example times an average multiple of 1. I'm kind of cheating. I mean, I did it only for one firm, but let's say we do it for 10 firms and the average multiple is still 1. Okay? Clear? So that's the basic idea. And you see from this basic idea, it is really a very different approach to dividend discount and discounted cash flow. Right? It's very different. There is no discounting. There is not even a formula in here, except for these tiny things here. But it's like really a very different approach. No discounting, no calculations really. It's very, very simple everything. The problem is really applying this is still not easy because you need to find those comparable firms, and that's often a challenge. But I will give some guidance on how to find comparable firms towards the end of this unit. Yeah, so this is a bit of an overview then on multiples. The value of the firm again is entity value and equity value. There are different multiples, hundreds of multiples, and whether you end up with the entity value or the equity value depends on which multiple you use. So there are entity multiples and there are equity multiples. At the end, again, it's not really that relevant because entity value minus debt is always equity value. Okay, so and here you have a value of debt is often approximated by the face or the book value of debt. Okay. So one multiple that is very commonly, very frequently used, probably the most famous multiple is the so-called price earnings multiple, the PE multiple. I'm sure some of you, many of you have heard about that. This is the current market value of the firm's equity divided by the earnings. And earnings here are earnings that belong to the owners. So this is typically net income. And typically we use future earnings, so next year's net income expectation. Okay? One of the most commonly used multiples because data is very easily available, price, earnings, very simple. People like it. It basically shows the relationship between the price and the earnings. So if you have earnings of $1 per share and a price of $15 per share, the multiple would be 15. So what this means is that the price earnings ratio of 15 means price earnings multiple of 15 means you have to pay 15 times the current or next year's earning to buy the share. Okay? Of course, there are also problems with this multiple. You cannot use it if earnings are negative, for example. So price earnings multiple is typically nothing you can use for very young firms, for startup firms, especially young tech firms, because they very, very frequently have negative earnings. Okay. So this is a very short example. Assume that the industry average PE ratio is 16, and then assume that firms within the industry are all comparable. So if a firm has earnings of $1.13 per share, what is the share price according to the multiples model? Well, it's the 16 multiple times the earnings, so it's $18. very straightforward. And here we have an overview on different multiples, so it's kind of really just giving you a reference on which multiples exist, and this is also not all multiples that exist. There are book value multiples, cash flow multiples, alternative multiples, forward-looking multiples. It's like a zoo. I mean, it's like hundreds of multiples. Okay? So, of course, I don't expect you to know all of them. This is more like a reference on what is existing. Okay? So this is important to understand. This slide is important to understand why it is so crucial to only look at comparable firms. Okay? So what this slide here shows you is the price-earnings ratio across different industries. Price-earnings ratio across different industries. And what we can see is that in some industries, application software, it's above 50. And in other industries, major airlines, it's like 10. So a lot of difference here. A lot of heterogeneity in this multiples. So obviously now, if you have an airline, and you would apply a multiple from the application software industry, like 50, I mean, this would be vastly wrong, right? Because airlines have a much lower multiple than application software. So if you value an airline company, you should use multiples from other airline companies. If you value application software, you should use values from other application software companies. Okay? So that's important. Always use the values, the multiples that belong to a specific industry. Why are multiples so different, or why is the PE multiple so different across industries? Any ideas? Why could, like for some industries, like application software, you have to pay 50 times earnings to get the share. In another industry, you only have to pay 10 times the earnings to buy the share. Why? Yes, I think mostly growth potential. Right? I mean, it's like for some industries like application software, the assumption is that the current earnings or next year earnings are still low, but over time they will grow a lot, and then you will own the share, so you will also get the much higher earnings. So for other industries, airlines, car manufacturers, tobacco, especially, probably it's clear, there is limited growth potential. Like, I mean, they probably will not grow a lot. It's also already very mature markets. So growth potential is a very important factor that determines the magnitude of the PE ratio. Okay? And again, it's very important to use the ratio that of comparable firms. If we look at multiples over time, we also see that they vary quite a bit. So if you look at price earnings, which is the black line, it had a low of around 10 on average across in all industries in early 1980s. And then it had a peak of like 35 or so, beginning of the dot-com bubble. So there is a lot of time variation in the price earnings ratio. It goes up and down here, like a lot of short-term variation, but also long-term trends, which means that when we use ratios, multiples for valuation, I mean, we should always use current multiples, right? I mean, we should not rely on old data or something. Because if you calculate price earnings multiples from the 80s and then you multiply that to the earnings of a firm today, I mean, you will get very wrong prices. So we should always use very up-to-date data, because there is a lot of time variation in the price earnings multiple, but also in other multiples. This is price cash flow. My price sales is a bit more stable, but still, if you would scale that differently, you would also see that this is also moving quite a bit. Okay? So use comparable firms, use up-to-date data. Those are two important things. So some hints on how to do that in practice. Okay, so we need to identify comparable firms. That's the peer group. That's very important. In general, what we do is we use firms from the same industry, but that is only a rough guideline if you want. Firms from the same industry might not be perfect, because even within an industry, there can be a lot of variation. There can be a lot of heterogeneity. If you think about, I don't know, think about software industry, right? You have Microsoft, which is very established, very traditional, mature company, and you have a lot of young companies that are still much more growing, that probably also have very different business models. So even within an industry, you can have a huge heterogeneity, and it's not enough typically to just say all firms within an industry are comparable. That's typically not right. So we need to make really sure that we only look at firms that are actually really comparable. Okay? So the most important thing is that these firms have comparable business models. Kind of one step further is that if we think about a multinational perspective, we want to use firms from the same country. So if you do, I don't know, if your term project is about coal mines in South Africa, I mean, you should use other coal mines in South Africa or firms with similar business models, ideally. The issue is that, of course, sometimes, or actually quite often, this will not be possible. Because especially in smaller countries, there will simply be no other firms or not many other firms that have the same business model. Okay? So in this case, it's fine, it's okay if we use firms from other countries. It's not a big problem. So these multiples, they also have variation across countries, but these variations tend to be relatively smallish compared to variation across industries, business models. Okay? So as kind of a rule, make sure this is the most important thing. Same comparable business model, same industry. Same country, yes, if possible, but if not possible, okay. So one is more important than two here. Okay? How large should a peer group be? How many firms should be in your peer group? Well, something like 5 to 10 seems a reasonable amount of firms in a peer group. Can also be a bit more, can also be 20 or so. Less than 5, typically then things become very noisy. 5 is kind of a minimum. So make sure, again, comparable firms, very important. Okay? And sometimes it's hard to find comparable firms. Right? I mean, you will, if you try to do that, I mean, it really depends a lot on your industry. But for some industries, it's not easy to find comparable firms. And this is actually, I think this is an interesting case. This is the IPO prospectus of Spotify. So this is when Spotify went public, and then they said like which companies they used in their peer group. Okay? And I mean, if you think about Spotify at the moment when it went public a couple of years ago, I mean, it's not easy because Spotify is like a music streaming consumer service IT firm, kind of, right? There was no other public music streaming IT consumer business firm. So if there is no other firm that has the same business model, I mean, yeah, I mean, what should we do? And what they then did is they said, look, we kind of need to be a bit more broad in how we define our peer group. And then they included firms like Tesla in their peer group. Where is Tesla? Here. They had Tesla. They had things like Netflix, which is a bit more close. They had Expedia, they had Twitter, basically all IT consumer kind of firms. I'm not saying that this is all right. I mean, people can criticize that. There's often no right or wrong. I'm just saying that finding comparable firms often sounds very easy, but it is not. Especially for firms that are more novel in terms of their business model, it's actually often quite difficult. The second decision we need to make, The second decision we need to make is actually which multiple we want to use, right? I mean, we saw there were many different multiples. This is actually not such a difficult decision to make. This is not as important also as the peer group, because once you have defined your peer group, it's normally very easy to use different multiples, right? I mean, for nearly all of these multiples, the data that you need is easily available. So if you have your peer group, I mean, depending on data availability, you can easily use several multiples and calculate the outcome, and then you do the average, or you show the range, or something like that. So instead of using only one multiple, you can use 5 multiples, or even 10 multiples, and then you can come up with a statement like, according to our multiples valuation, the price ranges from $20 to $70, depending on which multiple we use. That would be perfectly fine. So this is another example of valuation, actually, that shows that, I mean, sometimes you are a bit more restricted in which multiples you can use, because, for example, this is when the Twitter's IPO valuation, when Twitter went public, it really had a bit of a problem because the income was negative. Also, revenue was crazy low. So if they would have used revenue or sales to predict Twitter's value, I mean, the value would have been very low. So what they then did is they did a multiples valuation based on the number, among others, of active users. Okay? So especially for young I mean, Twitter was probably not a startup anymore, but for young tech firms that have not yet, let's say, fully developed their business model, it's often necessary to come up with less traditional multiples, like number of users, or people having a paid subscription, or something like this. Okay? For more traditional firms, more mature firms, I mean, those traditional multiples, PE, price to book, those things, they typically work nicely. But for younger IT firms, they often have issues. Okay? So let me do that first, and then I'll go back to that one. So this is basically just an overview on frequently used multiples for different industries or sectors. So use this as a guideline for your project. It's not like mandatory, of course. I mean, you can use whatever you think is appropriate, and I assume I mean, if you are the industry expert, you are always free to deviate from these recommendations here. It's just like a bit of a recommendation. So if you have growth firms, for example, do not use PE, use something like price earnings growth ratio. Young growth firms with losses, often people use revenue multiples, or even like less traditional multiples, number of users, number of customers, number of patents, something like that. Depends a lot on the industry. But you can take a look. So this gives you a bit of an overview on how you can think about that. Okay? So this is also something I want to show to kind of make the point that I tried to make clear several times today even clearer. Valuation is very imprecise. Valuation is very messy. It's not an exact science. And people get it wrong all the time. Professionals get it wrong all the time. This is the IPO performance of Twitter versus Facebook. Okay? So when Twitter and Facebook went public, you can imagine they had investment banks, and investment banks have very highly paid professionals. And those people then spend hours and hours and hundreds or thousands of hours figuring out the right IPO price for Twitter and figuring out the right IPO price for Facebook, which is basically valuation, right? Figuring out the right price, the value. And what you see on this slide, I mean, if you want to summarize it in one sentence, I mean, they screwed it up. They got it wrong. Twitter, on the first trading day, had a gain of 73%, which is the equivalent of saying it was 73% underpriced. They sold the shares with a discount to the fair value that is crazy, 73%. So they left money on the table, an incredible amount of money. They could have charged much more for their shares, but they didn't, because they get the valuation wrong. Facebook is kind of the other example. Facebook got it wrong in the opposite direction. Facebook was overpriced during the IPO. Facebook actually declined after the IPO. They lost like 20–30% in the week after the IPO. You couldn't see it on the first day, but then it went down. The Facebook IPO was not particularly successful. It was overpriced. Twitter was underpriced, both quite substantially. So if you think about that, I mean, how should you get it right in a term project if people who earn millions for doing valuation and they get it wrong? So just to be very clear, yeah, the term project is not about getting it right. It's about you learning things. It's about you seeing how valuation works and also how sensitive those things are and how difficult it is to get those things right. And I very much encourage you to be very open about this uncertainty. You just say it's like, I cannot come up with a specific price. I can come up with a price range that is likely, but even that is uncertain. Be very open about that. And kind of really what I hope is that when you did your valuation, in the future, when you read analyst reports or when you read valuations from other people, you will probably understand better how fragile and how volatile and uncertain those things are. Okay? Good. So this is also for your term project. This is a website by an NYU professor who is called Damodaran. He's a real expert on valuation. He has written multiple books. On his website, you gotta look. I mean, sometimes it's a bit hidden, but you will be able to find it. Probably I don't know if I still have it open. I can show it. I closed it. So, but on his website, he has a lot of data, he has a lot of tools, spreadsheet tools for valuation, for example. So you can just go through his website. There is a lot of useful resources for valuation. And take a look. So he has some examples for valuation, some spreadsheets where he does the valuation. So it can be very helpful. He also links to his books. I mean, if you have a deeper interest in that, you can also take a look at his books. They are actually pretty good, pretty easy to understand, provide good guidance on how to do valuation. You will not need those books for the term project. It's really more if you have a deeper interest in that. Okay? Good. Given that this is a new chapter and that we have midterm today, I think we can stop a bit early today. So that's basically all for today. Next week we will do portfolio evaluation and finish Unit 4. Thank you very much, and yeah, all the best for the midterm today.